You want an apartment that doesn't smell like wet dog and regret. You want your own car so you can stop texting, "Yo, you free?" every time you need a ride. You want to function in modern society without paying straight cash for absolutely every major purchase. But standing between you and that basic level of financial freedom is a random 3-digit number. You have never met the people who calculate this number. You don't know the exact mathematical algorithm they use. And yet this invisible score decides what neighborhood you are allowed to live in, what interest rate the bank will charge you, and ultimately how expensive your entire life becomes. It feels completely sketchy. It is not exactly an illegal scam, but it is absolutely a highly optimized system built by banks for the benefit of banks. And if you want to win, you have to stop ignoring it and understand exactly how the mechanics of this game work. Today, we are breaking down credit scores with zero fluff. We are going to look at what actually matters, the behavioral psychology they use against you, and the exact frameworks you need to use this system to your advantage.
The reputation score. A credit score is basically your financial reputation summarized into a single grade, relying purely on your past behavior to estimate how statistically risky you are. Example, if your friend Jake asks to borrow $20, but he still owes you $50 from last month, you are probably not going to hand him more money. That is his credit score with you. So what? Multinational banks do not know you personally or care about your intentions. In the United States alone, over 200 million adults have a credit score, which means this invisible tracking system quietly controls the economic mobility of almost everyone around you. Okay, moving on. The psychological trap. Banks understand human behavioral psychology better than you do, heavily relying on the frictionless nature of digital spending. Example, when you swipe a piece of plastic, the pain center of your brain does not light up the same way it does when handing over physical cash. You get the dopamine hit of acquiring an item, but bypass the friction of losing money. So what? The industry wants you to accumulate a balance and get trapped paying minimum payments for years. If you pay your balance in full every month, they internally refer to you as a deadbeat because they cannot extract interest from you. Your goal is to be a deadbeat. Cool. Now, here's the problem. The FICO versus Vantage score. Most lenders use a specific scoring model called a FICO score, but the free apps on your phone usually show you a completely different model called a Vantage score. Example. Comparing a Vantage score to a FICO score is like comparing store brand cola to Coca-Cola. They look similar, the packaging is the same color, but the ingredients are different. So what? Do not panic if the score on your banking app does not match the score the car dealership pulls. The system is complex and has dozens of FICO variations tailored to specific industries, but the foundational data comes from the exact same place. Okay, moving on. The big three. Your score is built using raw data from 3 major credit bureaus, Experian, Equifax, and TransUnion, which act as massive private surveillance companies tracking your financial behavior. Example, you might have a collection account on your file that actually belongs to someone with a similar name because the bureaus do not communicate perfectly and frequently make mistakes. So what? You are being financially punished for a stranger's bad behavior. Checking your actual credit reports from all 3 bureaus at least once a year is not optional. It is mandatory maintenance for your financial life. Cool, let's look at the math. Payment history? Your payment history makes up 35% of your score. It is the single most important metric, and it answers one very simple question. Do you pay your agreed upon obligations on time? Example, being 1 or 2 days late usually results in a late fee, but the moment you cross the 30-day mark, the bank legally reports your account as delinquent. So what? A single 30-day late payment can instantly drop a great credit score by up to 100 points. Relying on yourself to manually log in and pay bills is an unnecessary risk. Set up automatic payments for at least the minimum amount due, always. Okay, moving on. The bad credit tax? Let's look at why this number actually matters in reality and how it physically drains your wealth over time. Example, you are buying a reliable used car for $15,000. With a strong credit score, the bank offers a 5% interest rate, making your payment $280. With a score in the low 600s, they hit you with a 15% rate, jumping your payment to over $350. So what? It is the exact same car, but over the life of that loan, the person with the lower score ends up paying thousands of dollars more in pure interest. That is the bad credit tax, and it keeps people trapped. Cool, here is the hack. Credit utilization. Credit utilization makes up 30% of your score, measuring exactly how much of your available credit you are currently using. Example, you have one credit card with a limit of $1,000 and you spend $800 on it. Your utilization is 80%. To the mathematical algorithm, you look desperate and heavily reliant on debt to survive. So what? Even if you fully intend to pay it off, the algorithm does not know that. You must keep your overall utilization permanently under 30% or under 10% if you want to optimize for a major purchase. Okay, moving on. The statement date hack. Your payment due date and your statement closing date are 2 completely different things, and confusing them ruins your utilization. Example, you pay your bill perfectly on time every month, but the bank reports your balance to the bureaus on the statement closing date, which usually happens a few weeks before your actual payment is due. So what? what? If you want to manipulate your score and make your utilization look fantastic, you have to pay down your balance before the statement closing date, not the due date. Cool, let's look at another trick. The credit limit hack. You can instantly lower your utilization percentage without changing your spending habits, simply by requesting a credit limit increase. Example, a $500 balance on a $1,000 limit is a terrible 50% utilization, but that exact same $500 balance on a $5,000 limit is only a 10% utilization. So what? Your score goes up overnight and you didn't have to spend a single dime to make it happen, simply because the ratio changed. Okay, moving on. The cash flow framework. Avoiding credit card debt entirely requires a solid cash flow system, specifically using the 50-30-20 rule. Example, you route 50% of your income toward fixed needs, 30% toward flexible wants, and 20% toward savings and investments. So what? If you actually manage your cash flow using this sequence, your credit card becomes a convenient middleman. You only swipe for money that physically exists in your checking account, harvesting rewards without paying interest. Cool, let's talk protection. The Emergency Fund Shield, a well-structured emergency fund, is your credit score's ultimate bodyguard against unpredictable life events. Example, your car breaks down or a medical emergency happens. If you do not have liquid cash, that expense goes straight onto a credit card, instantly spiking your utilization and tanking your score. So what? Keep 10% of your emergency money in cash, 20% in a savings account, and 70% in liquid mutual funds. When disaster strikes, you pull from cash reserves, not the credit limit. Okay, moving on. Credit age. Credit age makes up 15% of your total score. The longer your credit history, the more predictable and stable you appear to lenders. Example, you have an old starter card you opened years ago that doesn't offer good rewards anymore. You decide to close it to clean up your wallet. So what? You just intentionally deleted your oldest active credit line, dragging down your average credit age. If the card has no annual fee, you must keep it open. Cool, let's talk about variety. The zombie card? Do not close your oldest credit cards. Use them strategically to anchor your credit history without actively using them for daily spending. Example, keep that starter card open, put a single small subscription on it, set it to auto pay from your checking account, and put the physical card in a desk drawer. So what? Let it quietly age in the background, boosting your average credit age every single month with zero effort. You cannot rush the aging metric, so don't sabotage it. Okay, moving on. Credit mix. Credit mix accounts for 10% of your score, proving to the algorithm that you can responsibly handle different types of debt, not just plastic cards. Example, the system likes to see revolving accounts, like credit cards where the balance fluctuates, and installment accounts, like a car loan where you pay a fixed amount every month. So what? Do not ever intentionally take out a loan and pay interest just to improve your credit mix. Paying real money to chase a slightly higher fake number is a terrible financial strategy. Cool? Now here's the problem. New credit. The final 10% of your score comes from new credit because asking for money makes you look riskier to lenders. Example, you go to the mall and apply for 5 different retail store cards in one afternoon just to save 15% at the cash register. So what? To the algorithm, rapidly applying for multiple lines of credit signifies that you are suffering a cash shortage. Stop applying for random store cards just to save a few bucks. Okay, moving on. Hard versus soft inquiries. Every single time you apply for a new loan or a new credit card, the lender checks your report, causing a hard inquiry. Example, checking your own credit score on an app or a website is a soft inquiry. It does absolutely zero damage to your score. A lender checking your file to approve a loan is a hard pull, which drops your score by a few points. So what? You can check your own score every single day and it will never hurt you. Do not let older relatives tell you otherwise. Cool, let's look at a smart loophole. The rate shopping window. The FICO algorithm is smart enough to know when you are comparison shopping for a single major purchase, so it groups multiple inquiries together. Example, if you are looking for a car loan and 5 different lenders run a hard inquiry on your profile within a 14 to 45 day window, the algorithm groups them all together. So what? It only counts as one single hit against your score. This allows you to be a smart consumer and shop around for the best possible interest rate without destroying your credit. Okay, moving on. The 7-year itch. Derogatory marks are the financial system's knockout punches, including bankruptcies, foreclosures, and accounts sent to collections. Example, an account goes unpaid for long enough, the bank sells that debt to a collection agency, and they place a massive negative mark on your credit report. So what? That negative mark stays on your credit report for exactly 7 years, plus 180 days. It is a heavy anchor that drags your score down for almost a decade. Cool. Now here's the problem. The payoff illusion. Simply paying off an account that is already sitting in collections does not automatically remove the bad mark from your credit report. Example, you finally give in and pay off that collection collection account. It updates the status to paid, but the historical fact that it went to collections remains entirely visible. So what? To actually fix your score, you have to aggressively negotiate a pay-for-delete agreement in writing, getting them to completely remove the account in exchange for your payment. Okay, moving on. The error epidemic. If there is a negative mark on your report that is inaccurate, you have a powerful legal tool at your disposal. Example, you find incomplete or inaccurate information on your file. You file a formal dispute with the credit bureaus under the Fair Credit Reporting Act. So what? They have 30 days to investigate. If the lender cannot provide concrete proof that the debt is yours and is accurate, the bureau is legally required to delete it. Never assume your report is correct. Cool, let's look at a trap. The debit card trap. Using a debit card linked to your checking account does absolutely nothing for your credit score. Example, you live entirely on a cash budget, use a debit card for groceries for 10 years, never go into debt, and have thousands in the bank. You go to buy a house, and the bank treats you like a ghost. So what? The system does not reward you for living responsibly within your means using cash. It strictly measures your ability to borrow their money and return it. If you do not play the game, you lose by default. Okay, moving on. The income myth. Your salary, your massive bonus, and your total wealth have absolutely nothing to do with your credit score. Example, you make $500,000 a year but constantly forget to pay your bills, resulting in a terrible score. Someone making $30,000 a year meticulously organizes their payments and has an exceptional score. So what? The credit bureaus do not know how much money you make or what is in your bank account. Income determines your ability to repay a loan, but your credit score measures your willingness to actually do it. Cool, let's talk relationships. The marriage myth. Getting married does not magically merge your credit score with your partner's score. Example, you have a perfect 800 score and you marry someone with a 500 score. You do not suddenly average out to a 650. You both maintain completely separate files. So what? If you apply for a joint mortgage together, the bank will pull both reports and usually base the terms of the loan on the lower of the two scores. Your partner's bad credit history will absolutely impact your shared financial future. Okay, moving on. Piggybacking? If you are just starting out, you can legally steal someone else's good credit history through a process called becoming an authorized user. Example, a trusted family member has a credit card they have kept open for 15 years with a perfect payment history. They log online and add your name to the account as an authorized user. So what? That entire 15-year history is instantly copy-pasted onto your blank credit report. Your score jumps artificially overnight and you don't even need the physical card. Cool. Now here's the problem. The cosigner ruin? Cosigning a loan for a friend or a family member is one of the most dangerous financial decisions you can make. Example, your friend buys a car, you co-sign, and 3 months later they miss a payment. That late payment goes directly onto your personal credit report and your score tanks. So what? You are telling the bank that you are 100% legally responsible for the entire debt. If they default, the bank comes after you. Never do it unless you are prepared to pay the entire balance yourself. Okay, moving on. The sweet spot? You do not need a perfect 850 credit score. It is a complete vanity metric designed for nerds on internet forums. Example, you have a solid 750 FICO score. You do not need to obsess over squeezing out 5 more points just to reach 800. So what? Once your FICO score crosses the threshold of around 740 to 760, you generally qualify for the exact same premium interest rates as someone with a perfect score. Your energy is much better spent focusing on actually increasing your income. Cool? Here is the final reality. The corporate game? This system was deliberately designed to help lenders evaluate their risk and maximize their profits. It was not built to protect you. Example, if you are highly responsible and pay off your credit card in full every single month, the credit card industry internally refers to you as a deadbeat. They do not make interest off you. So what? You have to view the entire FICO score system as a video game. You'll learn the cold mechanical rules of the algorithm, you manipulate the mechanics, and you extract the benefits without paying them a dime in interest. The wrap-up. Let's recap. The FICO score is the only one that actually matters. Payment history is king, so automate your payments and never miss a 30-day window. Utilization is a massive lever, so keep your reported balances heavily suppressed by paying before the statement closes. Credit age matters, so keep your oldest accounts quietly aging in the background. Stop applying for random retail store cards and racking up hard inquiries. You can piggyback off a family member's history, but never co-sign a loan. Derogatory marks will haunt you for 7 years. Checking your own score never hurts you. And once you hit 760, you have essentially beaten the game. The ultimate takeaway is this: your credit score is nothing more than a reflection of your discipline in handling borrowed money. If you manage it properly, the system acts as a tool that accelerates your financial goals. Stop acting like a victim to a game you are required to play, learn the precise rules, and stop paying the bad credit tax.